Everyone's watching the Bank of Canada rate announcement like it controls their mortgages, but that's just not how it works. Fixed and variable rates are neck and neck right now, but with all the economic uncertainty, locking your rate could actually save you a lot of pain in the future. So keep watching as I break down what most people do not know about variable rates and how it could save you thousands. Hi, my name is Zen, and if you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. So this video is a continuation from the last video where I talked about how there's a lot of renewal shock potentially coming down the pipeline. And I wanted to make this video because when a lot of people ask me about what's going on with the mortgages and how it's going to impact the real estate market, what I actually understand is that most people don't understand mortgages and how they lock themselves in for like 3-5 years on something that they don't quite understand. And they all focus on the fixed rate and the variable rate, and they all think the Bank of Canada controls both those rates, when in reality, that's actually not the case. So this is why I want to take this video to explain it so that you understand each and every product, the pros and cons of each every product right now in second half of 2025, so that when your renewal is coming up, or if you're buying something right now, you know exactly what product is going to work for you in your personal unique situation, because there's no blanket statement for everybody because everyone has a different risk tolerance. So the first thing I want to show you is the difference between the lowest variable rate, which is the orange line right here, and the lowest fixed rate, which is the blue line over here. And you can see this data goes all the way back to like 2012. So it's got more than 10 years of information. Now, what I will say in general speaking is that most Canadians have always paid a premium for the fixed rate at 5 years. You pay a premium for the certainty. And you can see that over here from 2012 all to about here. The fixed rate, the blue line, was always on top of the orange line. And then weird things started happening in terms of the economy and the bond market and all that stuff, where at some point the fixed did come on top over here. And then obviously the pandemic came. Then you have your variable rates pinned to the floor while the fixed slowly kind of shot upwards in this direction. And then eventually the variable overshot it, and then the fixed is a little bit lower. Now, we're in a situation similar to what we saw in 2019, where we're basically converging on a variable and a fixed to be exactly the same thing. And then most people just look at the rate that they're getting when they close down their home or when they're renewing, and they forget about some of the important aspects and the difference between a fixed and a variable. So the first thing I want to address in this video right up the top really is that the Bank of Canada does not control the fixed rate. The 5-year government bond yield does. And I'm not going to get nerdy into all of this stuff, but basically you can see right now is that the bond yield is going up, which means that fixed rates are also going up. So the likelihood of you getting a fixed rate that's lower than what it is right now is probably very low. Now, obviously, a lot of things can change the bond market and things are readjusting all the time and no one really has an idea of what the hell is going on. But generally, the trajectory right now is going upwards. So the fixed rates are generally going up. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. Now, I have explained many times how the Bank of Canada only controls the variable interest rate, but now I'm going to go really nerdy and use actual examples for you. So in front of you right now are actual mortgage commitment documents that show you what the interest rate is. So in this case, the person who got this mortgage got a 1.68 mortgage. And based on the interest rate, you can see what vintage this was. And what most people don't understand on how banks get to this 1.68% is that your variable is the prime rate, or in this case, what they call the VRM base rate, plus or minus some kind of number, which we generally call the discount. So to get to the 1.68 number, you do one of these. You go 2.45, which is the prime rate that I have over here, and then you minus 0.77, so minus 0.77. And this is how you arrive at 1.68. Now, here's the important thing. The prime rate, or this VRM base rate, is exactly what the Bank of Canada controls. So if the Bank of Canada increases their interest rate, say from 2022 until 2023, that prime rate goes from 2.45 to say 4.95, and it makes this variable much higher. The Bank of Canada controls this rate over here. It does not control the actual variable. And this is very important because what a good variable is based on what the banks give you as the discount. Let me repeat this. How good your variable actually is based on your discount, not the Bank of Canada. So the bank you're getting the mortgage from is dictating how good your variable is, not the Bank of Canada. And the reason why I wanted to pull this and show this to you is because right now we are seeing discounts getting lowered. And in speaking to my mortgage brokers, when the Bank of Canada does drop their rates, a lot of times the banks that you're getting mortgage from are actually reducing their discount. So say instead of 0.77, they actually subtract a couple points off and say it's minus 0.5 instead, which ultimately makes the variable the same thing before the Bank of Canada makes their rate cut. And this is what most consumers do not understand. Now, depending on the economy and how aggressive banks are, the discount does fluctuate. But what a lot of banks do instead of providing a larger discount is they give you cash back. This is the same concept as if you were going to rent a place, and instead of dropping the base rent, they give you 1 or 2 months free and they just toss other things in. Now, this chart here is to illustrate that because the prime rate is very much tied to the Bank of Canada overnight rate, which is what the Bank of Canada controls with interest rate increases and decreases, this is why variables go up and down. And you can see basically in like the early 2000s, it is in lockstep. It goes up, this goes up. It goes down, this 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 goes up, this goes up. It's just in lockstep because it's a direct transfer in the last 20 years. So in summary of the variable, you have to understand this. Your variable is made up of the prime rate, which is actually on the bank websites, which I'll show you shortly, and then your discounts. So right now, in the instance of going to get a mortgage at Scotia, their prime lending rate is 4.95. It hasn't changed since the last rate cut, which was in March. Yes, it's been that long. People have been holding out for their rate cuts from the Bank of Canada. If you go to TD, 4.95. If you go to RBC, 4.95. You're trying to get my drift, right? So if the Bank of Canada does cut by another 25 basis points, it's going to bring this to 4.7. So let's go back to analyzing the difference between fixed and variable. So if you go with the variable right now, let's just use BMO as an example because they have great cash back according to this website, you have 4.53. On your fixed, you're at 4.51. It's more or less the same, right? And if you look at the different banks, more or less the same. So let's calculate what your actual variable discount is if you have a 4.53. So what we're going to do is take 4.95 minus 4.530. That means your discount is 0.42. Is that a great discount? It's reasonable right now, but I can tell you during the pandemic years, you could have a discount of 1%, which a lot of people are still carrying right now. If you go back a few months, I was seeing some variables with a discount of 0.62%. So is this a great variable for you to be getting right now? I would say the answer is no. And with the chance of the Bank of Canada cutting their rates getting lower and lower, and now we're only seeing that maybe one rate cut for the balance of the year, this is exactly why I made this video that, hey, a fix actually does make a lot of sense right now instead of trying to ride out the variable because your discount on variable sucks. So now let's go through some examples of why you should actually go with the fix. And I'm going to go through some of these points that are on this article. And the ones that I've highlighted yellow are actually what I find the most important. So if the variable rate is stressing you out, and I've always said this, yes, a lot of people try to time the market, trade the market, and do everything. But at the end of the day, if you're losing sleep over the property that's providing a roof over your head, just lock it in and you will enjoy life so much more. And this way, you also stop watching the Bank of Canada announcement rates, just like me. It's not healthy. And the second one is right now, your lender will let you lock into a great fixed rate in the low 4s. And this is what I was showing you earlier before. If you're seeing a low 4 somewhere around here and you can lock it in, it actually is a good rate given the fact that the bond yields are kind of on the rise right now. You can see that right now. So if you can get a low 4s, it may be worthwhile. The probability of you getting into the high 3s are probably gone already unless you're in an insured mortgage. And the final thing that I would mention is that to make sure that you don't plan to break, which includes refinancing or selling the property in the near future based on your terms. So if you're going to lock in for 5-year fix, just make sure you don't plan to move or you don't have to move in the 5 years. Otherwise, your penalty is really, really bad. Because if there is a chance of you having to break the mortgage, you might as well go with a variable. And here's the example right now. You're not going to be hanging on to your mortgage for a long time. So if you plan to sell in 1 year, or if you're an investor and you know your tenant is leaving next year or they've given you notice and you're coming up on renewal, go with a variable. Do not go with a fix because you're going to pay a penalty through the roof when you actually sell the investment property when the tenant is gone. And the second one is your variable rate is much better than the fixed rate. And I have seen this come up a few times where because the discount is so great on the variable going into a fix, it didn't make sense. So you might as well just ride out the variable. And when there is an opportunity to lock into a fix when your existing lender or other lenders give you that lower fix that is in the market, then you can lock in at that point if that's what you're going for. So you're kind of timing it and you always have to stay on top of the market. But this kind of makes sense, I would say, if there's like a maybe 50 to like 100 basis point spread. And here's a tricky one that I'm going to explain. You have a great variable rate with fixed payments. Now, I said in the last video that this is where I think a lot of mortgages will have an issue because they would have had variable rates from the pandemic with fixed payments in 2021. But if you're riding it out, that current mortgage payment is so low. And if you have the ability to make lump sum payments in the future, or you're already making additional payments on your own accord, you've basically locked in a low mortgage monthly mandatory cost, and you're giving yourself an option to prepay it so that you're not falling behind. This is just better for your cash flow ultimately, but just be mindful you do not let the mortgage amount grow, because that's basically a variable with a fixed rate mortgage does. And the final thing that most people actually don't understand is that you can always convert your variable mortgage into a fixed anytime you want. And the reason why a lot of banks generally will do that is because if you break a fix, they make more money. If you go with a fix, they lock you in for a longer duration. So a lot of times they'll be like, hey, you can lock in, but you just have to lock in for 5 years. So you're comfortable with whatever that fixed rate is based on whatever the economy looks like at the time you're trying to lock in, then go for it. There's no penalty. The problem is if you go from fixed to variable, that is actually breaking a mortgage. I hope this gives you an idea of more in-depth nitty-gritty of how the variable and the fixed actually work, and you understand kind of the inside plumbing of your mortgage term for your property, because I really don't think people know a lot about it. Another thing that a lot of people don't understand is that if you have a variable rate with a fixed payment, so again, this is your TD, your BMOs, your CIBC, and your RBCs, and you got that mortgage during the pandemic, there's a very high chance you may be in for a payment shock, which is exactly what I talk about this video, where 60% of Canadians, when they're renewing, will have a payment shock. So make sure you check out that video to protect yourself and understand what mortgage you have so you're not caught off guard. I'll see you in that video. Until next time, your move, your future. See ya.